hope everyone had a safe and fun 4th of July. And this week, let's talk about these rates really quick that just don't seem to be going down. In fact, they're going up. The chances of 2 more Fed rate hikes seem to be pretty high at this point, given that inflation was readjusted and it is higher than what we originally thought. So it was adjusted from 1.2 to 2 for Q1. So that pretty much, it definitely locks in a very high likelihood, almost guaranteed rate increase for July. And then definitely, I'm sure maybe another one after that, like before November. So anywho, that is kind of what we're looking at. And it's looking like rates are going to stay higher for longer. Now, the interesting part about this is that it doesn't seem to be slowing down the residential side of things. So people are still buying homes. Now, when I say that, it seems that it's mostly kind of that, starter home, first-time home buyer kind of price range. Some of the higher end homes are having price reductions, unless of course they're just like, fabulous location, layout, all that good stuff. Obviously things that are priced right are selling, but I'm seeing a lot more of that in the residential world. Now, when it comes to the commercial side of things, it's really a mixed bag, just depending on what asset class you're talking about. Now, we talk a lot about multifamily here at Pacific Shore Capital. It seems to be like the majority of what we had been doing over the last few years, of course, because that market was so strong. Now, things are not really moving much because cap rates still have not, they've come up a little bit, but they're still really off considering the interest rates that you're getting. So rates are easily in the 6s now. So we're looking at really like more like 6.25 to 6.75 in terms of rates. You might be able to get that a little bit lower just depending on your deal. So that's really crushing purchase opportunities. Not only that, but inventory is really low. So I'm starting to already hear real estate brokers talking about going and doing something else because they're not making any income. Part of that is interest rates are high, but the other part is there's just not enough inventory to go around. That is the same on the residential side and the commercial side. So a lot of the top brokers or real estate agents are doing okay, but for everyone else, there's just not enough inventory to go around. So I'm hearing that a lot. Now, the big topic that everybody's been talking about is about this commercial real estate, loan issue we're going to see is all these loans are going to be coming due. They're not going to be able to refinance because rates are going to be so high. They're going to have to, pay down the loan significantly, which is going to cause an issue for people. Is that going to be an issue? Maybe. Absolutely. I can see that. But I think it's also what's going to get the market moving again. So there's going to have to be a little bit of pain before we can readjust and get things going again. So as an example, on the residential side, I was just having a conversation with Kenny about this. The thing is for your home, I'm just talking specifically about your home, but you get a 30-year fixed. And even on like a 2 to 4 unit investment property, a lot of people got locked into a 30-year fixed rate. Their rates are really low. They don't have to refinance or do anything. That's going to cause some more struggle on the residential side, which is really just an inventory issue, right? People are in these really crazy low rates, and why would they sell? Even if they don't want to live in that home anymore, they want to go, they want to move up or they want to scale down or anything, change neighborhoods, whatever, they're not selling because their rates are so low. Well, on the commercial side, that is not the case. So it's sort of a double-edged sword. For some people, it's going to be a problem because they won't be able to refinance even the debt that they currently have in place when that time comes, or they're going to take the risk of their rate adjusting up. So they might just end up taking these higher rates. Luckily, those have caps for those people who don't have balloons. So if your loan goes to an adjustable, that's great on the commercial side, because at least it's not the best thing, but at least you can keep your loan on an adjustable basis until hopefully rates come down enough that you can qualify to refinance the entire debt without bringing in more cash. Same thing for multifamily, where people are doing 3, 5, 7, 10-year fixed rates. So at some point, those properties are going to go on adjustable or become due depending on what loan program they have. So that's going to cause some movement in the market, which is good for us because that means that we will have some more inventory on the market. There will be a need for refinances. There will be a need for financing in general and for shifting around of portfolios, whether it's buying or selling or trading up or trading down or getting out, whatever the case may be. So that's going to help the commercial market keep moving. That means that there is some over the next couple of years, there's some hope, right? Even if rates stay up for a prolonged period of time, there's going to have to be that adjustment period, but people cannot just stay in their loans because they don't have 30-year fixed rates. So that's good and bad, right? It's good for us for inventory. So what am I doing now? What are we seeing in the markets now? So I'm not seeing a ton of multifamily business. I'm seeing people trying to make multifamily work. There are a couple of people who are super active in the market still, so they still see that the fundamentals are very strong, especially given that we think that rates are going to go down at some certain point. And the thing that we we are pretty certain about is that we will continue to have appreciation, whether it's in rents or property values. So if you can make the numbers work, people are still buying, but you're having to search a lot more. So in terms of what I am seeing, I'm seeing a lot of people adjusting their strategies. So for example, if you have a multifamily owner who owns primarily here in San Diego, they are looking in other areas where there is more opportunity. For example, some areas that are in a bit of a downturn that were really, really hot for a time, but they are experiencing issues. Those are like bigger cities, let's say like the Bay Area, for example, things like that. So they're looking at opportunities elsewhere in other markets. The other thing that I'm seeing, for example, there was this huge thing about Airbnb. And of course, there's all this talk right now about Airbnb having issues. And then of course, all the people in San Diego are in an uproar about, multiple owners having all these licenses. But what I am seeing is the Airbnb people, a lot of Airbnb investors are adjusting their strategy to start buying boutique hotels because you don't have to deal with any licensing issues, right? So now the downside about boutique hotels potentially is the financing can be more of a challenge. That being said, that market kind of knows it. So for example, doing this creative finance type thing is a lot easier when you're talking about purchasing boutique hotels because those owners already know that financing is not that easy. It's not that easy to just go get a boutique hotel loan. Now we've been doing more and more of that financing. We've been doing it through SBA. We've been doing it through private money lenders. And then if you can put a lot of money down, you can just go direct to a lender and get a loan, but they really only want to give you maybe 50 to maybe 60, probably closer to 55% loan to value. So I am seeing that shift from the Airbnb model over to some boutique hotels where there's a little bit more opportunity and the cap rates look better and the returns look better and you don't have to worry about changes like local government changes or rules being in place that would affect you on that side. The other thing that I'm seeing are a lot of people who are usually older trading out of their multifamily assets and into triple net assets. So the good thing about triple net is that right now cap rates are a little bit higher on triple nets because obviously rates are higher and you're really capped, right? Like we call these coupon clippers, right? You just get the cash flow every month, which is really nice. Obviously on the downside, if your tenant vacates, like let's say you've got this single triple net building and then it's, that person vacates. Like for example, I had a client who bought a bunch of Walgreens and CVS's, trade out of those. And then I just saw in the paper that Walgreens was closing like 400 locations. I think only 150 of them are here in the US and the rest are in the UK. But things like that can be a little bit scary. So you really, if you're going to buy triple nets, you need to be very careful of that. And so you could lose money on the sale. But because cap rates are up, some people are using the strategy of buying a triple net, planning on holding it for 3 to 5 years because it's better than putting your money in even a CD or a bank account. When you do the math, like most of us need tax write-offs, right? So if you put your money in treasuries or you put your money in CDs or a money market account, you're going to pay tax on that interest that you're earning. Whereas if you use that cash to then buy real estate, something that does cash flow for you, you're going to get less cash flow because obviously you're going to get debt. And then by the time after you pay your debt, your distributions are going to be less than if you obviously had 100% of that sitting in a bank account somewhere, but you will also get the depreciation. You're going to get tax write-offs. So that's really good. Not only that, but you actually have a chance of having appreciation. So you make money that way. So I still think buying real estate, it's just harder to find deals right now, is a better solution than parking your cash in a CD or a money market or treasuries. Now, that being said, yes, put your money in those vehicles like the CD or the money market or the treasuries while you're looking for an asset to purchase. So that's a good vehicle to just do that. But I wouldn't just park my money there and just not worry about it. Like this is a good time to be looking for deals because it's only going to get harder when rates do finally come down. So anyhow, you guys, thank you so much for all of your support. I appreciate it. I thought it'd be a good time to dive in to say what's happening in the market because we are not quite, it's like nobody wants to push the recession button yet, but the market is definitely slowing down. And so it's nice to know what exactly is happening out there. What are people doing? What are people buying? And then I can touch a little bit more on financing next week because that is always a moving target. I do talk about that every week generally, but I'll dive in a little bit deeper to what kind of financing people are getting across all of the asset types under that commercial real estate umbrella next week because there are options. There is financing out there, which is the good news. It's more like find a property that makes sense and then we can get the financing, but things have changed. So I will get into that next week. I hope you guys had a fabulous holiday. Make the best of this short short work week, and I will see you next week.